worries me very much, so that if we do not push to a sustainable growth, I mean, there is no way out, and it's not only Italy in this situation, seems to me.
Sure. Okay. I mean, we will look at the merits of what governments are doing and just how effective the austerity packages will be in a moment. But I just want to first of all just get a sense of how you all think how bad the problem is at the moment, because Philippe Legrain, there are those who say, oh, don't get too exercised about what's going on in Greece. It only accounts for 2 to 3% of the European Union's GDP. So even if Greece were to go bankrupt and get out of the Eurozone, well so what?
No, well, personally, as I said, I think the Greece should have restructured its debts. I reached an agreement to pay back, less than the face value of its bonds. And I think actually that is the only long-term sustainable solution. Its debts are 150% of GDP, or going to reach that. That entails paying out, nearly 10% of a shrinking national income to foreign creditors.
But it's not just Greece.
And that's clearly unsustainable at a time when the economy is in deep recession, at the time when massive cuts are being made elsewhere. But the danger is that, people having, correctly identified worries that Greece is insolvent, then start panicking about other economies which are in trouble, which do need to make the reforms that Emma has talked about. It's absolutely essential that we combine measures to reduce deficits with measures to generate future growth. But we shouldn't start thinking that Spain is identical to Greece.
But even if it were, I mean, the point I'm trying to make, Emma Bonino, is that actually, let's look at the facts behind this. And France, Italy and Germany account for something like 70% of the European Union's GDP. So really, even when people talk about Portugal, Spain and Greece all combined, we shouldn't really get too exercised, because in the scheme of things, they're not the big players in Europe.
I think you are right in some way, but on the other side, I think that things are so interconnected that it's not pure figures that count. It's also a question of feeling and a question of panicking or not panicking. And I think that the situation was so bad that to push member states really to come forward in one night to such an emergency stabilization scheme means that they really thought the situation was really bad, even beyond the pure figure you're mentioning.
But I think we should keep in mind two things. Lehman Brothers was very small, and it triggered a whole mess because we didn't know quite how to cope with it. Look, we've reached the point where we knew institutions, some of them were too big to fail. Then people said, well, Greece is too small to fail. Now there's Spain, which they say is too medium-sized to fail. We're going to have to accept failure, or else we're going to have a mess. And I agree with Philippe, we should have let Greece restructure its debts, perhaps a 30% loss to lenders, instead of going through all this nightmare that we're going through now.
Philippe Legrain.
I'm not sorry.
No, go on, Emma Bonino.
No, I'm not so sure. I disagree, frankly, in the sense that it's not a question of Greece. It's a question that all other economies, banking system and banks in Germany, Spain, Italy were involved in any case in Greece. So it would not have been only meaning that the only Greece would have to restructure. That would have in any case brought about major difficulties in all other banking systems throughout Europe.
But that is precisely the point, is that, European and American banks made huge mistakes, first by underpricing the risk of dodgy American mortgage assets. They made an additional risk, which was to assume that Greek government bonds were as safe as German government bonds, and they've been bailed out again. The biggest beneficiaries of this is not Greece. Greece actually is borrowing at premium rates from other European countries which can borrow for less. So actually, Greece is not costing the Germans and the French anything at all. The big beneficiaries, and you saw that their share prices rocketed on the day after the bailout package was announced, are French and German banks. So yet again, those banks and their creditors are being bailed out. And that is not only desperately unfair, but it also stores up absolutely huge risks for the future, because it means they can gamble as they like, and heads they win, and tails taxpayers lose.
So the damage then done to European banking could be quite considerable.
I think the damage of what the system we have now, whereby the big banks know that they're going to get bailed out, is creating huge new risk, and that is the biggest risk, in my view, for a future financial crisis.
Irwin Stelzer, then the question to you is, how much damage do you think the European banking troubles could do to the global economy?
Again, it depends how we handle them. I mean, I think Philippe is right. The big problem that we have now created is that we've created moral hazard. Everybody knows that there will be huge wealth transfers from taxpayers to lenders if there's a problem. Look, everything could happen. You keep coming back to this, what might happen. A lot of things might happen. But good policies can prevent those things from happening. Will the banks eventually take losses? Yes. Is that a bad thing? I don't think so, because it at least tells them don't do it again. They need the kind of disciplining that teenagers need at this point, because they keep piling risk on risk, knowing full well that the taxpayers are going to be available to bail them out. That's just not a good way to set up an international banking system. And I think we're overlooking one important thing. There is substantial growth in the developing world and in Asia. There will be export growth in Europe, especially if the euro hits parity with the dollar or $1.10. And so there is a source of external growth out there that might, just might, provide the revenues that the governments need to handle some of the debt they've incurred.
Okay, Emma Bonino, you've been talking about the tough austerity measures that have been introduced by European governments, including your own, but there are those who feel that actually cutting back on public spending in order to tackle deficits could actually compromise fragile global economic recovery. What's your view on that?
Yeah, I do agree, particularly if these cuts are not in line with or are not with profound structural reform that are badly needed exactly to sustain and to promote growth. So I'm coming to the Italian budget, the other one, I don't know the details. But if I look at the Italian budget, there is no anything referring to, for instance, liberalization of labor market or to open labor market to women and young people. There is nothing for pensions and to raise the age of retirement, which is one of the major problems in my country. There is nothing on demography, and particularly on legalizing immigrants, which is one of the possible temporary or the possible solution. So what worries me is not so much to cut this public spending, particularly, which is, by the way, due in my country. But what worries me is that long due structural reform are not to be seen nowhere in this package.
Okay.